What if I told you that the most powerful and profitable investors on Wall Street today aren't people? They're machines, algorithms that operate 24/7, making thousands of trades a second, driven by a force that's changing our world, artificial intelligence. There's a hedge fund so secretive and so successful, it's averaged over 60% in returns annually for 30 years, a feat that makes Warren Buffett look like a novice, and the secret to their success. It's not about picking good companies, it's about math, data, and probability on a scale we've never seen before. We'll uncover how AI and unimaginable amounts of data are creating an entirely new Wall Street. We'll meet the quants, the rocket scientists behind these billion-dollar algorithms. We'll explore the exotic data they use, from satellite images to your credit card transactions. And we'll ask the big question: can you really trust a machine with this much power? Hey everyone, I'm Evan, and welcome to Evan's Quant Lab, the place where finance, data, and artificial intelligence converge. But the person who truly brought it to life was a math professor named Ed Thorp. Then he turned his sights to the biggest casino in the world, the stock market. He applied the exact same principle: find a small, persistent mathematical edge and exploit it systematically. His fund was wildly successful, and it laid the blueprint for the quant revolution. Today we are pulling back the curtain on one of the most disruptive forces in modern finance: quantitative investing. This is fundamental investing. It's about deep analysis of a company's health, its management, its brand, and a healthy dose of business intuition. They ask the question, is this a good company to own for the long run? In the next 20 minutes, we're going deep inside this secret world. Let's get into it. By the end of this video, you will understand the revolution that is happening right now and see the stock market in a way you never have before. For decades, investing was dominated by legends like Warren Buffett. But in the shadows, a new breed of investor was born: the quantitative investor, or quant. They ask a different question: is there a verifiable, repeatable, statistical pattern in the data that predicts a profit? They come from backgrounds in physics, mathematics, and computer science. They're the rocket scientists of Wall Street, and their goal is to systematically remove human emotion, fear, greed, bias from every single decision. Quants don't care if a company is good. This idea isn't brand new. Its roots go back to the early 1900s. In the 1960s, Thorp famously used probability theory to develop card counting and prove you could beat the casinos at blackjack. He literally wrote the book on it. If the early pioneers like Ed Thorp lit the quant fire with math and statistics, then artificial intelligence poured rocket fuel all over it. So what is AI in this context? Forget about sci-fi robots. When we talk about AI in finance, we're mostly talking about machine learning. They can only answer questions that are explicitly covered in that book. A machine learning model is like a student who has read every book in the library. As new data flows in, the AI model can learn and adjust its strategy in real time. This is the game changer. It doesn't just memorize facts. It learns the hidden patterns and relationships between all of them. But this isn't where they get their edge. Everyone has this data. It can now write a completely new essay, or in our case, make a market prediction based on that deep, holistic understanding. Here's the best way to think about it. A traditional computer program is like a student who has memorized one textbook. They can see in near real time if sales at Chipotle are trending up or if fewer people are subscribing to Netflix. Traditional statistical models are great at finding simple, linear relationships. If A happens, then B happens. They are turning the entire world into a measurable data set. They are measuring public sentiment, the collective mood of the internet, to predict if a stock is about to rise or fall. A massive part of a quant firm's job isn't building the AI, but finding, cleaning, and validating this data to make sure their engine is running on the purest fuel possible. But the market isn't simple. It's chaotic, complex, and filled with hidden connections. AI excels here. In the world of quant investing, this is the absolute truth. The most advanced AI is useless without high-quality fuel. It finds those complex, non-linear patterns in mountains of messy data that no human analyst could ever hope to find. It's faster, it's more scalable, and most importantly, it adapts. You've probably heard the phrase data is the new oil. Quants start with the basics, what we call traditional data. This is the stuff you find in official company reports, revenue, profit margins, P or E ratios. The real edge comes from what we call alternative data. This is where things get fascinating. This is the high-octane fuel. Quants use satellite imagery to count the number of cars in a retailer's parking lot to predict their quarterly sales weeks before the official numbers are released. They track the construction progress of a new factory from space or count oil tankers in a port to gauge global supply. They analyze huge, anonymized sets of credit card transaction data. They use natural language processing or NLP to scan millions of news articles, social media posts, and product reviews every single day. They track website traffic, mobile app usage, even the flight patterns of corporate jets to anticipate mergers and acquisitions. But here's the key: the principle of garbage in, garbage out is absolute. So what happens when you combine brilliant minds, powerful AI, and this incredible data? You get some legendary successes and some catastrophic failures. Founded by Cold War codebreaker Jim Simons, it is the most successful hedge fund in history. We mentioned their 66% average annual return earlier, but here is the most mind-blowing part. They are reportedly only correct on about 50.75% of their trades. First, the legend Renaissance Technologies Medallion Fund. They use their massive data and computing power to find a tiny, almost invisible statistical edge. Then they exploit that tiny edge through thousands or even millions of leveraged trades. Just like a casino, a small edge repeated millions of times becomes a near certainty of profit over the long run. That's barely better than a coin flip. So how do they do it? They operate like a casino, but with great power comes great risk. This technology is not foolproof. We are talking about AI systems that can read all the financial research in the world and then generate entirely new, undiscovered investment strategies from scratch. While it's still early, quantum computers promise to solve certain complex optimization problems exponentially faster than any computer today. This could allow for perfect portfolio optimization and risk simulation on a level that is currently science fiction. Autonomous AI agents working as tireless data scientists. With the most complex AI models, we know what data goes in and we know what decision comes out. We've seen how alternative data gives them a unique view of the world, and we've looked at the incredible potential and the catastrophic risks. For all their power, these technologies are still just tools. We are becoming the strategists, the risk managers, the ethicists, and the ones who have to ask the right questions. You won't want to miss it. It helps the channel more than you know, and you won't miss our next experiment here in Evan's Quant Lab. The AI is the ultimate co-pilot, but a human must always be in the captain's chair. What part of this technology fascinates or scares you the most? Let me know your thoughts in the comments section below. I read all of them. Because the ultimate responsibility for the decisions these powerful systems make will always rest with us. AI can process data at an inhuman scale, but it has no real-world understanding, no common sense, and no ethical judgment. But we often have no idea why the AI made that specific choice. It could be acting on a hidden bias in the data or a meaningless correlation. This lack of interpretability is a massive ethical and regulatory challenge for the industry. That's when a model learns the past data too well, including its random noise, and then fails spectacularly when it faces new market conditions it's never seen before. In a single week, many of the world's top quant funds started losing massive amounts of money, all at the same time. The likely cause: too many of them were using similar models and chasing the same factors. When one big fund was forced to sell, it triggered a domino effect, causing all the other algorithms to sell, creating a death spiral. First, there's the risk of overfitting. In just 45 minutes, the algorithm went haywire and lost the company $440 million. It effectively bankrupted them before they could even figure out how to turn it off. This led to the Quant Quake of 2007. Then there's pure technological failure. In 2012, a company called Knight Capital deployed a faulty piece of trading software. And this brings us to the biggest risk of all, the black box problem. So where does this all go from here? The revolution is far from over. The next wave is generative AI, think beyond analysis, and on the distant horizon there's quantum computing. This all sounds like humans are being written out of the equation, but I don't think that's the case. Ultimately, this brings it all back to the human element. The future of finance isn't man versus machine, it's man plus machine. The role of the human investor is evolving. So we've covered the quant revolution, from the card-counting pioneers to the AI-driven funds of today. Now I want to hear from you. After seeing all this, would you trust an AI with your life savings? If this video gave you a new perspective on the financial world, do me a huge favor and hit that subscribe button and ring the bell. In our next video, we're going to get hands-on and explore 3 sources of alternative data that you can actually access and use for your own analysis. Thanks for watching. Keep learning, keep questioning. I'll see you in the next one.